Hi everyone, welcome back to another video. The date today is the 18th of February on the morning 11:50 a.m. So the market is open today. And you can see my portfolio now with a $10,000 cash deposit is currently standing at $9,300. It's down by about $650 at this moment. And today we'll do a slightly longer video as I have not been updating the portfolio for almost 2 weeks. And so get ready for a jam-packed update on the market and as well as the stocks, the companies in my portfolio. We'll cover also what's happening with the US market, SPY, Triple Q, and as well as some gold, silver, and crypto updates. And then lastly, we'll update the individual companies. All right, without further ado, let us begin. So over the past 1-2 weeks, the major indices have been volatile, but recently, the tick up as tech stocks rebounded, like today. You can see some of the stocks that are rebounding. And let's take a look at SPY today. SPY today is up by about 0.74%. You can see it's a green candle day at this moment. So after a choppy start to the year, the major indexes are holding modest gains. S&P 500 and Dow Jones Industrial Average just each up about 0.1% rise in a recent session, while the tech-heavy Nasdaq Triple Q bounced from a less than 1% intraday drop to end up about 0.1%. So notably, the Dow hit an all-time high, crossing the 50,000 mark for the first time after a big rally. Still, the market is quite volatile, as last week, Triple Q has its worst week of 2026. It's down by 2%. Let's take a look. You can see, let's look at the weekly candles right here. So it's down by about 2% last week. And this is amid all the AI-driven fears, disruption caused by AI, most notably in the software companies, the SaaS company. So overall, market breadth is improving. So over 60% of the S&P 500 stocks are outperforming the index. So, but investors are mainly cautious and balancing strong labor data with hopes that inflation is cooling. As precious metals, the gold and silver, it has been a roller coaster for gold and silver. Both soared to record highs in late January, only to plunge in a historic sell-off. Gold briefly topped $5,600 per ounce, then tumbled about 9% in one day to the about $4,900 mark. You can hear. Tumbled all the way down here. And silver spiked above $120 per ounce before crashing 26% to the $80. You can see the SLV chart right here. So the highest it went is about $120, $110, and then it dropped 26% down. It's a crash here, about 26%. So what's going on? So essentially, safe haven demand drove a parabolic surge for gold and silver. And amid the economic uncertainties, but when the White House nominated a more market-friendly Fed chair and the dollar rallied, traders took a profit. Hence you can see the sell-off right here. So since then, volatility ranged gold and silver seesawed through February. So as of mid-February, gold is around $4,009 and silver is about $73. And today is about the $70 mark. So outlook, if the interest rate stabilize and the dollar remains relatively weak, metals could find support, but any whiff of tighter policy or calmer geopolitics issues might keep the cap on the further gains. A little bit on the cryptocurrency, Bitcoins and friends are on a wild ride of their own. So Bitcoin actually surged above 70k in the early February, then later there's a sharp rebound, only to struggle holding that level. So Bitcoin remains down 23%. Let's take a look at the Bitcoin chart. You can see here, So it dropped closer to the 60,000 mark. And then now it's hovering around the $70 from $68,000 to about $70,000 range mark for the Bitcoin. All right, that's all for the Bitcoin. So let's take a look at the account itself again and look at the securities. So I'm holding a total of 17 companies. And so let me just look at the first one. Let's start with Meta. So Meta share price today at $637. Meta is on a tear, proving the doubters wrong with blowout earnings and bold AI moves. For Facebook and Instagram parent, they crushed actually their Q4 expectation, with revenue up 24% year on year to about 60 billion and EPS at $8.88. So stock jumped initially after the earnings, or the Meta earnings, I mean, but the AI skepticism and so the how much they have spent on their capex actually caused after their earning profits, right, to the share price to drop. You can see their share price pop up after earnings, and then it start to come down over the past 1.5 weeks. Next, AMD. Let's take a look at AMD. So this is I rank this company based on the size of the company in my stock portfolio. So Meta is the first one, AMD is the second one. So AMD, they actually delivered record results to finish 2025, capitalizing on the high demand for their AI chips, their high performance AI processor. So AMD revenues are actually very good. They surged 34% year on year. So CEO Lisa Su also said that they are entering a multi-year super cycle for the AI high-end computing, and AMD is well positioned to capture that growth. So notably, AMD newest MI300 AI accelerators and the general EPYC server CPUs are gaining traction as alternatives to NVDA in their cloud deployment. So investor got spooked by so AMD stocks after their earnings actually dipped 7%. And to me, I feel that if you don't have any AMD shares, it's a good time to buy after their earning. It dipped down to about $200, and the second day it dropped by about $190. So it's a good time to add if you don't own any AMD stocks. So why did it drop? So investor got spooked by a soft outlook. The management guided Q1 2026 revenue down roughly about 5% sequentially. So citing a lull in the semi-custom sales, the gaming console chips. So essentially after the holiday rush, right, console chips demand is expected to drop double digit in 2026. So overall Q1 sales 9.8 billion, while a bit more consensus unblowing the doors off. But AMD expect that to be a blip for Q1, so it's forecasting strong growth across PC, data center, and the embedded chips later this year in 2026. So market sentiment for AMD is still positive. Yep. So going forward, just keep an eye on AMD AI initiatives because it's launching a new GPU and the new adaptive chips. And it also wanted to challenge NVIDIA dominance over the chip segment, and it also scored a partnership with Microsoft for their AI chip development. Alright, so that's all for AMD. Next, we look at this one is the first SaaS stock here, Adobe. So Adobe, the concern for Adobe, as usual, is the AI disruption that may cause video editing to be much more easier using AI rather than Adobe set of softwares. So we'll have a look. We'll see how it goes. Adobe, they themselves, they do have their Firefly software. It's like the generative AI image tool for their software editing. Personally, I tried before. So it'll make you subscribe and pay to their service. So it's quite I mean, for now, Adobe remain, for some investor, they may feel that it's undervalued. It's a good opportunity to buy more Adobe at this moment. But there are other investors thinking that the AI may take over most of their profits. Other smaller companies may be able to come up with good video editing software using AI without all the technicals, handling all the technicals of editing, video editing, and and this may cause a lot of disruption for Adobe business model. So for me personally, I do own quite a number of Adobe shares. Other than this portfolio, I do have other account with Adobe shares as well. I would like to wait and see to understand better the whole picture before I would like to add more Adobe share unless it dropped way below my expectation. So now currently they actually dropped to my buy point of 250 a few days ago, but I didn't add any shares. And I will still want to monitor further for especially for Adobe. Yeah, I just start to get a little bit anxious or cautious about Adobe for at this moment. Alright. Microsoft, another SaaS company. Microsoft finds itself in a paradox. Business is booming, but investors are a bit uneasy about the price of that growth. Let's unpack their latest quarter. So revenue hit 81 billion. It's a plus 17 year on year, a record, powered by very strong cloud demand. Azure, Microsoft Cloud Platform, grew 39% year on year, slightly topping expectation. In fact, the company said Azure could grow 37% next quarter as well, so indicating sustained momentum. Microsoft is also seeing success monetizing AI on Azure via services like OpenAI ChatGPT, which it backed, and its new Copilot AI assistant for Office 365. On that front, CEO Satya Nadella revealed 15 million users are now paying $30 per month for Microsoft 365 Copilot, a promising start for AI in enterprise productivity. So why did the stock dip 6% after earnings? In a word, spending. Microsoft is also spending huge on their capex. It spent 37.5 billion on capex in the last quarter alone, and over 200 billion since 2024 on AI and cloud infrastructure. So the massive investment clipped margins a bit. The cost of revenue rose 19% versus revenue plus 17%, leading some portfolio managers to worry about declining operating leverage. Microsoft AI partnership with OpenAI, once seen as a huge competitive advantage, is also being re-evaluated now that Google's Gemini AI is coming on strong. Essentially, Microsoft is spending big to stay ahead in the AI race, but the payoff may take time, and competition is heating up. Nadella insists it's earning that this investment will yield returns for decades. He might be right. Microsoft cloud business is still a cash cow, and they guided to roughly 81 billion in the next quarter revenue. So bottom line, Microsoft core franchise, Windows, Office, Azure, is performing well and is pushing the envelope on AI across the board. The company is even accounting for OpenAI differently now. So its 27% stake gave a big one-time boost to earnings. That's all for Microsoft. Celsius, ticker symbol CELH. Celsius, a drink company, is still growing fast, but revenue up sharply year on year. But the stock got hit because management flagged noisy near-term numbers as they integrate acquisition and transition distribution. Watch how smoothly the Pepsi distribution plus new brand integration plays out, because that will drive sentiment short-term. Long-term, they are still gaining market share in energy drinks. Their share price has not been doing that great. Over the past 1-2 weeks, you can see it has been on the sliding down pattern. Right, this is a long-term play, so we have to monitor closely, probably in the next few weeks to a year. Hopefully you'll bounce back higher and all to their all-time highs. Okay, so this is a company, not a SaaS company, of course, and would definitely not be affected by all the AI disruption. Next on the list, let's take a look at Health. Health continues to execute with strong sales growth. They did well for their earnings, and it's supported by also their successful product launches and strong demand in both cosmetic and skincare. Investors are watching margin and inventory closely, but overall the brand is still winning with younger consumers. Any updates on guidance and international expansion will be key. Next, let us look at FTNT, cybersecurity. Today is quite flat for FTNT. This company has been showing improving momentum again, with billings, products, demand stabilizing, and margin remaining strong. The big theme is enterprises prioritizing network security and platform consolidation. So watch watch their growth and the large deal activity for the next leg up. So next, let's take a look at one of the new holding in my account, ServiceNow. ServiceNow, they bottom at about $98. I recently managed to add quite a few shares for ServiceNow for this account and for my other account. ServiceNow remains one of the strongest enterprise software names. I think they are like not far behind of Microsoft in my opinion. So in terms of the management of the company, with they have solid subscription growth and strong AI-driven upsell, the company is also positioning itself as a key workflow layer for enterprise AI adoption. So their guidance and their large deal wins for watch it and for confirmation that demands stay resilient. So now maybe let us take a look at some of the numbers for ServiceNow. I have for you here, you can see the financial trend charts for ServiceNow. Let's take a look at their revenue. So over the years, you can see their revenue is generally doing very well on the uptrend. You can see right here. So very nice slope up. For their operating income, you can see this also going up on uptrend. Same for the net income. Not so the net income, but you can see over the last 3 years has been doing well. Last 3-4 years. So let's move on to this chart right here. You can see their free cash flow over here. Their operating net cash flow and net income. Let's take a look each one by one. For the net operating cash flow, nice slope up over the years. Their net income, same like this one before. So you can see that, over the last 3 years has been good as well. Their free cash flow, nicely uptrend. And their stock-based compensation is also on the uptrend. So to me, all these are very important numbers that we need to take note. The company's company revenue, company strength, and I like what I see in their numbers. Amazon, let's see. You can see my Amazon share. I'm holding one share of Amazon, and now it's on the losing end. Let's take a look at the chart today. Amazon is benefiting from their improved AWS growth and a strong ad business, but investors are still focused on their capex, mentioned in the last video, and their spending level. The key is whether the AWS AI demand stays strong enough to justify the aggressive investment. A retail margin and delivery efficiency remains important too. Companies like Amazon, Meta, Microsoft, Google, they've been spending a lot, spending very heavily on their AI development. So not sure whether the next few years will bring them back the profits that they wanted to see, that they expect. So if not, this share price, it may not grow as fast as the current, or it may not grow as fast as it does for the past 1-2 years. That's how I take on this. All right, next we take a look at next company, NVDA. So companies like I mentioned above are buying AI chips. So the main AI chip makers, NVIDIA, who most likely will be the beneficiary on all the capex spent by all the big tech company. So NVIDIA is still the top AI infrastructure winner, driven by the demand for their data center, GPUs, and continued expansion of the AI build-out. The main watch items are supply capacity competition from AMD and custom chips like AVGO, etc. And also as well as that their regulatory exports updates. As long as AI capex stays hot, NVIDIA stays in the driver's seat. Their share price has been quite flat over the past months, highest at $212. So in fact, if NVIDIA goes lower to around this mark, $170, I think it's a good buy point. Okay, that's all. Let's take a look at the next one. Today's video is a bit long, so I try to just don't talk too much. So Salesforce, another SaaS company, which I also own. For this company, I'm not as worried as Adobe, not as worried as like Adobe is. But this is the company which you can say that I'm the after Adobe, I'm actually worried about ServiceNow. Not ServiceNow, Salesforce. The second most worrying company that I'm holding, because I do own quite a big percentage in my portfolio as well. So Salesforce, their numbers are also very good. They are performing well and stable growth, strong margin, pushing hard into AI with their Einstein and agent style automation. Investors want to see AI monetization fast so that it can re-accelerate in their business. So margin discipline plus buyback continue to support the stock price. Okay, next. MRVL, got a small holding of MRVL here. It did by a bit recently, but for the past few days has been trading upwards. So MRVL is getting more attention as an AI picks and shovel play via networking and data center connectivity. The focus is on AI-related demand for hyperscalers and whether guidance keeps stepping up. So any slowdown in non-AI segments is in the main risk. Okay, next, we take a look at Palo Alto first. Today down by, initially it was 8% to 9% I think, but now it hit back up again. Lowest today is $147. And so PANW, Palo Alto Network, just had their earnings. They forecast lower than expected earnings for its next quarter despite reporting a rise in fiscal second quarter profit as spending linked to recent acquisition and ongoing integration work weigh on per share guidance. So shares fell like you saw earlier in the trading day, and their revenue in January quarter rose 15% year on year. The GAAP net income increased to 432 million. Earning per shares increased to $1.03 from 81 cents. So generally the earning is not bad, just that they may expect some slow growth. That's why it caused a sell-off today. Auto continue to show strong platform momentum, especially in the cloud security and next-gen subscription. The market is watching large deal flow from ARR growth as companies consolidate cybersecurity vendors. If IT security budget holds up, Palo Alto remains one of the highest quality names in the space. Next, let us take a look at the next stock. That will be Netflix. Netflix is a company that I started a position not too long ago. So you can see my buy point right here. But it goes lower, I bought another here. I also have some shares in other accounts. For Netflix, they continue to benefit from the pricing power, the subscriber growth, and the improving ad tier traction. So investors are watching content slate execution and advertising growth rates. And their share price drop is mainly due to the acquisition, like I mentioned in my earlier videos. So now not sure whether they will get the acquisition done. So it has been dragging for quite a while. Next, let's take a look at the next one. Palo Alto after that. Palantir today doing well, up about 4-5%. So Palantir remain key as an AI enterprise software winner. So strong momentum, strong earning, very, very good earning previously. And there are strong momentum in the US commercial deals with EIP adoption. So the big question now is their valuation of the company. And depending how you look at it, some people might feel it's a way too overvalued company, although their growth is very strong. And recently it has dropped back down to about $125 range here. So if you'll be good if you have already added some shares, today it hit back up by 5% to about $140 now. Alright, the last two company in my portfolio, FISV has been a reset phase after a major earning guidance disappointment. So investors are focused on their execution and visibility. So it remains in the dark clouds until investors actually see more more stability and more growth and their rebuild credibility before I think it can trend back up again. Okay, so the last company in my portfolio, SOFI. SOFI has been improving with strong member growth and better profitability, helped by its own banking deposit strategy and broader product cross-sell. The key risk is credit quality. If the economy weakens, especially in the personal loan, if credit stays stable, operating leverage could keep improving. Alright, so that's all for the company's updates. And it's been a whirlwind tour through the market and for our portfolio as well. So despite some bumps, most of our picks are executing quite well, with many harnessing I also took this the start sell off to add some SaaS company. Whether you continue to go down or you continue to go up or you go up after this, no one knows. But as long as I still find their fundamentals are still strong and their business model is still right, I will still continue to add shares for this SaaS company. Okay, so if you have enjoyed this long video today and all this breakdown of the individual company, please do me a favor, please smash the like button. And if you want to see more videos like this, do subscribe for more. And if you, of course, if you want to leave a comment, please do so. And I will see you in the next video. Cheers, bye.